Good morning, everyone, and thank you very much for joining me this morning. This is the morning market review with myself, Russell Shaw. I'm the senior market specialist at FXCM. My email address rshaw@fxcm.com, and today is Wednesday, it's the 11th of May 2022. Just going to bring up our high risk investment warning, and I'll then bring up the commentaries disclaimer. Good morning, Katie and Zanetta. A pleasure to have you on the webinar as always. Just a heads up, of course, it's Wednesday, so we'll go until the top of the hour, and then I'm going to jump across and do the crypto minute, because the crypto minute is, of course, I want to keep it separate. I'll put both of those onto the website. Hey Anna, nice to have you on the webinar as always. All right, here's the market commentaries disclaimer. And just our references, MarketScope 2.0, CNBC.com, and TradingView. I just want to get through the CNBC European article, just so that we are aware of what's in the headlines for today. It reads as follows: European markets head for positive open as investors look ahead to US inflation data. European stocks are expected to open higher on Wednesday as investors look ahead to the latest inflation reading. The higher open in Europe comes after choppy trading sessions in the region and in markets further afield. European stocks advanced on Tuesday as global markets rebounded from a broad sell-off in recent days, prompted mainly by concerns over inflation and rising interest rates and the potential for global recession. And I think that paragraph there says it all. So it's really inflation is one of the big topics, not the only topic, but they all. We can talk geopolitics, but again, that would lead to a conversation in terms of inflation when it comes to economics. We're getting CPI out today at 230 ZA, at 130 UK, and I think all eyes on that number. We're going to get the PPI tomorrow as well. All right, on Tuesday, US stocks seesawed as the major averages struggled to recover from 3 days of heavy selling. They brought the S&P 500 to its lowest level in more than a year. Investors are looking ahead to US inflation data for April on Wednesday, which is expected to come in slightly below March's 8.5% and could signal that inflation has peaked. So that again is a very important paragraph. The expectation is for a moderation in inflation. So if there is a surprise to the upside, that could prompt a large sell-off. Okay, so the inflation data, again, key release for this week. Recent market volatility has been driven by investor concerns over rising interest rates and question marks over how aggressively the Federal Reserve will act to curb rising inflation. In addition, investors continue to monitor the ongoing conflict in Ukraine and the lockdowns in China. Overnight, shares in Asia Pacific were mixed as investors watched for market reaction to the release of higher than expected Chinese inflation data for April. Meanwhile, US stock futures were higher in early morning trading Wednesday ahead of the forthcoming US inflation data. German inflation data for April is also due Wednesday. Earnings from a wide range of companies are set to be released, including Alstom, Commerzbank, Continental, Siemens Energy, amongst others. Okay, let's go through to TradingView for a moment. This standard deviation graph that I'm going to go into that in the cryptocurrency webinar. So if you're interested, join me for that. I'm just going to take off here. Let's just take a look at some key economic metrics which I think are driving sentiment at the moment. We've looked at them previously. So the first one is the US core CPI. All right, and the reason that we're looking at core here as opposed to headline, clearly headline affects all of us. But in terms of interest rate policy, that all comes down to the core number. Why does it come down to the core? Because it strips out energy, it strips out food inflation. it strips out the supply side, which the Fed has no control over. So that's why they look at the core numbers, and they look at core PCE, but it's very closely related to CPI, just a slightly different methodology. All right, so the core number here, what we want to do is we just want to add an indicator to this. Let's just add that RSI. Standard settings here, that would be the 10 based on a median calculation. And yeah, I'll just show you 10 median calculation, okay? And it's really is getting to a point where we would regard this as overbought as a in terms of RSI theory, and the overbought condition does seem to coincide quite nicely with the peaks in inflation, which of course would coincide nicely with what the economists are suggesting, that we've reached sort of the apex, that we're starting to plateau. Where I think we've got to pay particular attention is not on the core CPI. I actually want to change the narrative slightly. I want to change it up to the PPI, and the way we're going to do that, we're going to put in US PPI year on year, okay, and we're going to pop that in. Okay, so slightly different, a slightly different representation. The reason we've got these sort of weird looking is because I've got it on logarithmic, which we don't have to do it on a percentage base. Okay, so here's the PPI. PPI clearly is in an overbought area, and what we'll do here is we will change this to all. All right, so we've gone back all the way to 1951. You guys, you've seen this chart before, but I really want to just emphasize this because this is the data point that's coming out today. And you can see that when the RSI hits above 80, it's really when it comes back below 80. When it really comes back below 80, that's really when we're starting to see the end of the inflation on the production side. It's a little bit of an anomaly there. The other key just to take into account here, we're looking specifically at the spikes in PPI, just the spikes. Okay, the times when the supply side squeeze was really of note, and we got this part over here. We've got this part over here, and of course, given the geopolitics now, we've got a huge supply disruption exacerbated by strict lockdowns in China. So how does this help us for understanding the core inflation? Well, we have to add the core inflation on top of this. We have to try and get some sort of intermarket relationship to see if we can build a hypothesis which makes some sort of sense. So what we'll do is we're going to just press plus here, and I'm going to add back that core number. And I'm just going to put it as a new price scale, but on the same chart. Okay, Katie, I just saw your notes. Okay, cool. All right, and we've got this orange line here. I'll just move it as such, and you can see when we've got these spikes. Okay, when we've got these spikes, this is I think something that we need to take note of. It leads the core number up. So here's the spike. So we're going back all the way to the early 70s. What's happening in the early 70s? That's the first oil shock. Okay, so that's after the Yom Kippur War, and then the OPEC cuts off oil supply to the west. Right. So that's what happens over here, and we get this huge spike up on PPI, and then we get this huge, once it crosses back down, that's where the core number starts moderating. Here's the second oil spike. This is after the revolution in Iran prompted the second oil shock. PPI leads it up, and we've got, it has to cross back down, it has to lead it, and then PPI leads core inflation down. Here's the next price shock. Here is the invasion of Ukraine by Russia. It's creating all sorts of supply constraints. Okay, it's pushing CPI up, but it hasn't reversed. It's not leading the core number down, and that's what we've got to be watching for now. Okay, we've got to be watching to see if there is some sort of moderation. I think not on the core side. I think we've got to be looking to see if there's some sort of moderation on the supply side. So let me just rephrase it. Not so much on the consumer side. I think it's really a factor now in terms of the headline inflation moderation, because that seems to be what is going to bring the core number down. So there's a bit of an ambiguity here. Whilst we looked at the RSI on the CPI, and it did look as if there was an overbought condition, okay, the fact that we've got this supply shock, the spike on the PPI, I don't think we can underestimate that. I don't think we can underestimate that. So this now becomes very important, I think, to monitor. We can add in a few other series here just to build on this intermarket type of relationship. And the next thing we can add is, of course, the unemployment rate. Before I do that, I beg your pardon, let's add in the GDP growth rate, I beg your pardon, because unemployment directly linked to GDP, right? So let's put that in, US GDP year on year, and let's get this into the chart. I'm going to put it in a new price scale here, and it's got this sort of, it's this turquoise aqua type of. Now take a look, when the inflation is coming down, when the inflation growth has already started coming down. When inflation is coming down, growth seems to have already started coming down. We jump to where we are now, so growth has started coming down, so perhaps that does lead the inflation number down, because it seems to be lining up with the previous spikes when we had those supply side shocks. Well, okay, fair enough. What does it mean? Okay, so this is I think the next part of the puzzle. We now add in the unemployment rate. Okay, so let's add that in. New price scale. All right, and it's now this. It's got this yellow. It's the yellow line. Now we've got a very messy chart here, but just bear with me. Bear with me. Let's go through to the time the unemployment kicks up. I'm going to change these red verticals so it kicks up over here. Okay, so look what's happening here. Unemployment's coming down. Sorry, GDP growth is coming down. Unemployment starts spiking up. That unemployment spike up is accompanied by the decline in inflation. Okay, let's move it over here. We've got growth coming down, inflation moving up, and then inflation only starts moving down when unemployment starts moving up. Okay, jump through to where we are now. We haven't started the payment. We haven't started the adjustment in the unemployment market. Now, this actually is very much what theoretical, classical theoretical, let me try and phrase this properly. This is very much what classical economic theory theorizes. let's just do that. I understand it's top of the hour, so we don't have much time. I'm just going to end off with this chart over here, and then we'll jump through to our crypto minute. Just give me 5 more minutes here. I'm begging your pardon. So what we have here is, okay, I'll just pull this up very, very quickly. Okay, this is just a standard normal economics chart. Equilibrium is obviously where the supply and demand intersects. Demand is this downward sloping, supply is this upward sloping. Let's just put that in. Okay, this is inflation. And I'm just going to write unemployment here. It's not really unemployment, it's more the x-axis usually is real GDP. What happens is with supply side shocks, that's what we're seeing now with this jump up in the supply side, in the PPI. Okay, we're seeing the supply shift to the left, and that's why we're getting this increase in inflation. That's why we're getting the decrease in GDP. Now, the question is, what do you do? What do policymakers do to combat that? And the real answer, the real answer, which nobody's going to admit, is they can do very little. Okay, so you can either move demand out through an expansionary monetary policy, which they won't do, or they can try a contractionary policy, which is what they are doing at the moment. And you can see that it does lower inflation, but of course, it hurts the unemployment. It hurts the unemployment. So that's exactly what the theory suggests is going to happen. And of course, the very last sort of piece of this puzzle is, okay, well, let's add in the repo rate. Okay, well, let's add in the repo rate. So I fully acknowledge that this is a tremendously busy chart. It hurts the eyes, but not the repo rate. That's our local, sorry, Fed's fund rate. Too local. Fed funds rate. Here we go. Okay, so let's add this in and put in our new price scale. Okay, and this one I'm going to really change the color because this is really what I want to highlight. And then we're going to jump off onto the next. Let's make this really easy to see. So we've got a thick black line. What is that thick black line? That is the Fed funds rate. Okay, that is contractionary monetary policy. Well, it's kicking up when the unemployment rate starts. The unemployment's got a slight lag. That's so by the time unemployment starts really feeling the bite, interest rates are moving. Okay, same with the second oil price shock. Okay, we are lagging in this cycle, lagging. So the CPI print now is something that we need to watch very carefully. The PPI print out Thursday, tomorrow. Okay, we want to keep track of this because there seems to be some sort of causality when there is a supply side shock. When we see it represented in the PPI, that's when it becomes important to watch because it leads that CPI, and if it leads that CPI, of course, the policymakers can only respond with a contractionary monetary policy, and the real adjustment that takes place in the labor market, and it looks like it's going to be a painful adjustment. So we want to watch that very, very carefully. Okay, the crypto link, yes, certainly. Let me just pop that in. Bear with me one moment. I'll get the crypto link for anybody that's interested. All right, so if you guys just take a look in the chat, I'll pop it in there. I'm going to wind up this part of the webinar. If there's any questions here, hold them for the next one. We can address them in the next one. If you just go through to the chat, you will see the link there, and please join me for that, Lisa. All right. See you guys in a few moments.